to look at actually how to use scanning, free publicly available scanning tools to actually look for and locate high probability trades. This is going to be able to be used on anything from, you can use it in Forex, you can use it in options, you can use it in equities. We're going to be looking at some of the core fundamental things that we need to have when finding a trade. Of course, before we get started, just a standard disclaimer, which you've probably already seen several of today. This essentially just says that stock trading does involve risk. And of course, I'm not going to be able to go into all the details of what those risks are today, but I'm sure many of you know those. So we'll get started through a little bit of an introduction to Acorn. For those of you who haven't already worked with us or been introduced to us, we were founded back in 2007 by a small group of traders, myself and several colleagues that I traded with. And we focused mostly on the technical side of the market. So 80% technical, 20% fundamental. And it was through this combination, I think one of our debut really into the success of our strategy was in 2008, where we got clear indications from some of the signals I'm going to be sharing with you today that the market was about to crash. June 6, 2008 was where our technical indicator diverged. Our money flow was going out and told us, you know, you might as well stick to the sides, and we got out. The beautiful thing about that was the fundamental indicators we used as well had actually said the same thing on the same day. So when we actually saw this perfect storm, if I can tag that word a little bit, this was when we said, all right, well, when everything lines up, we might want to be a little bit concerned, and or at least raise the flag. So what I'm going to do here is let's kind of summarize where are we at in the world today. Let's have a think about the backdrop. Maybe it is a backdrop considering what these points are going to say, but you know, let's look at where we are in the economy. We've got central banks that are pumping money into the economy with no end in sight. We've bailed out all the major banks, but what about investors? How much wealthier is everybody? Has the rally we've seen in the market been based on true economic activity or just another bubble? Of course, you know, we've had bubbles of the tech bubble, real estate bubble. Are we headed for another bubble? These are some of the questions we might need to be asking. Because of course, we are at all-time highs on the S&P 500. Optimism among market players is at a peak. I mean, if you look at where there's actually success appearing, it's actually in new technologies like cloud computing, you know, Yelp, Facebook. These are all the companies that are having these monster rallies. But I mean, where we look across the world into manufacturing and the underlying fundamentals, we're seeing mass layoffs of 30, 40, 50% of the workforce, their global workforces. You know, very concerning when you start to see the only real growth happening in virtual worlds like Facebook or Yelp. So are we building towards another top? If so, what is your plan going into this potential problem? What is your plan going into the 17th of October when we hit the debt ceiling? Whether we go through it and it gets approved, or what if we bounce down off it and there's trouble? What is the plan? And most importantly, how are you going to maximize those opportunities and protect against loss? And these are all questions that we should be asking, because we probably all learnt some, had some experience hurting from 2008. And what amazes me is that a lot of the people that I've worked with over the last 6-7 years in a training capacity, I say to them, what have you changed since 2008? And well, they said, well, you know, I've recovered, so I guess it's okay. I said, well, not really. What are you doing differently? What questions are you asking? What types of alterations to your strategy have you made? And a lot of the time, people don't have an exact answer for that. And I'd just like you to think a little bit about that, because it all does really come back to having a plan and being able to execute it with pinpoint accuracy if you're going to have consistent success. So those are some of the statements I wanted to kind of cover or ask a couple of questions. But let's ask another question. You know, what type of investors are you? Because I always find that in all the presentations that we do, we have a very diverse group of traders. We've got a great crowd here today. If you just want to throw that into the chat window, what type of trader you are, whether you're more of a long-term investor, the Buffett type, a swing trader, 3 days to 3 weeks, or whether you're a day trader, it'd be great to just get an idea. Yeah, a lot of swings and days, option trader, great. Agnostic, if it's like that. Absolutely, that's great. Now, I mean, where I like to specialize in is just like you, Charles, day to swing. My background has been trading mostly with swing trading for the last 12 years, and I have found that the reason I'm attracted to swing trading the most is because of something that is talked about in the 4-hour work week. It's about the minimum effective dose. I love trading because I love traveling. I love trading because I love working for myself. I love trading because it's exciting. But when it stops becoming a lot of those things is when it's a job, when you have to be in front of the screen every day, every hour in order to make money. So that type of trading, while it can be very fruitful, and I still do a lot of day trading, swing 3-day type trades have been where I like to focus on. And when you're doing swing trades, the idea is to have a methodology of finding positions and strategies that can manage your portfolio for you, which is what we're going to be talking about today. So when you're deciding what type of strategy to be, or what kind of strategy to follow, you have to ask yourself the question what your investment objective is. I just detailed some of my, the normal cliches. And this is usually what people are looking for. They're looking for time for family, toys, freedom, all these types of things that you see in any kind of investment product. But it's really not about, this isn't really about why your investment objectives are. It's about what you want to spend your time doing if you did have an alternative way to make money. The next question I'd like to ask is, how do you make most of your decisions? Is it technical? Is it fundamental? Just to throw up in the chat box whether most people are here technically based or fundamental or looking to learn. Just as people type in there, what I've found is that a lot of people have technical backgrounds and a lot of people have fundamental understanding, but where I see a lot of people's mistakes happening is one of these 4 things. A lot of people that make their decisions based on news, reacting to news. A lot of people buying things because their friends tell them to, because their friends are in the stock or their friends work for the company. They're getting a great new advice from their mutual fund manager or something. I'm not saying all mutual fund managers are bad, but I know a lot of people who aren't happy at the moment who have been firing their brokers that I have been meeting with over the last few years. Of course, things that you're familiar with. This is a photo of Vancouver, where I am now. Doesn't look as nice as this today. But a few years ago, you bought BlackBerry because you had a BlackBerry, or you bought an iPhone because you had an iPhone. You'd have a significantly different group of happy people versus unhappy people today. So these are some of the things that I see people doing. And the problem with this is why most of these decision-making processes is why people end up losing, because they make emotional decisions. So they fail to limit losses, they average down, they buy into emotion, and essentially what that just all boils down to is investing emotionally and lacking a strategy. And it's not surprising that that is the case when everything around you is designed to mess you up. Everything is designed to create emotion and scare you out of your position or excite you into buying. I'll pose a question to you. If you were a market guru, if you were the big boy in the market and you had $100 million worth of a particular stock to sell, right? You felt that the stock market was at its all-time high, and that the market is about to crash or significantly pull back, and you've got this $100 million worth of stock to get out of. Are you going to be going out there on all the news channels and all the PR wires and be saying, everybody get the hell out of the market because it's going to crash? Would you be saying that? Or would you be trying to get out of your position hoping everyone else still thinks it's a good time to buy? Yeah, Kramer did do that. In fact, a lot of news presenters, in fact, in October of 2008, came out and said, yes, it is a wonderful time to buy. The market is not there. The financial system, in my mind, and I do realize it's the pot calling the kettle black here, but it's not there to help you. It's the reason why they talk about the 1%. It's because the reason it's 1% and not 5 or 10 or 20%, the reason it's 1% is because 1% is making money off 99%. And that's why they're making so much of it. There's an old saying that says the greatest trick the devil ever played was convincing people he didn't exist. In the financial system, I apply it this way. The greatest trick the financial system ever played is keeping people confused, scared, and ignorant, and that they can't do it themselves. So if you take that kind of analogy and apply it, how do we start to track what's really going on? Well, we need things that we can quantify. You know, we need things that we can actually say that is exactly what's going on and measure it, put it into an Excel table, strip it down so that we're not listening to the noise anymore. We're not listening to what people want to manipulate us into doing simply so we can put more money in their pocket. What we need to be listening to is what is the business decision in our trades. And I watched a great presentation actually a few months ago, and one of the speakers spoke in the presentation about the fact that the stock market is something that you're doing business with. So treat it like a business, right? And if you're looking at a stock that you really like, and you like it at $15, and it's priced at $30, and the stock's basically saying, hey, would you please buy me at $30? You get the opportunity to say, no, I don't agree. $30, I'm not going to do business at that price. Just like you wouldn't take a job if you're used to getting paid $100,000 a year and they offer you $20,000, you wouldn't take that, right? Well, hopefully not, unless it's for other philanthropic reasons. But the idea about having a strategy is you need to know what you're willing to accept, what is going to meet your business plan as a trader, and how hungry you are, yeah. So the question I'd like to ask everybody is, if you could take a pen and paper and you could draw exactly what you want the perfect chart to look like if you were to buy it on Monday morning, what exactly would the chart look like? And if you could draw that out, what would it look like? Secondly, if you were then able to actually write down exactly what conditions would be there, what would they be? Right? So what would the fundamentals be, perhaps, if you're a fundamentalist? The price-to-book ratios, price-to-earnings, things like that. What would the indicators be if you're more technically based? So what would volume look like? What would the candlesticks look like? What would the indicators be doing? Not just one, but several. And what would they all be combining at that perfect point in time if you had the opportunity to tell the chart what it should look like? Okay? And the reason I ask you this question is because, again, a lot of people don't know exactly what the chart should look like. Now, if you don't know what you're looking for, how can you find it? If you don't know what you're looking for, you're simply, a lot of people are just scanning through. One of the traders I met last week was just going through every stock in the S&P 500. Every couple of days, he'd go through all 500 stocks, trying to look for something that jumps off the page to him. I don't know stocks that do that talk to you, but that's what he was going through. That's a very laborsome task. And that's why most investors have trouble, because they don't have a strategy, and if you don't know where you're going, any road will take you there. So let's kind of push forward here. So what do we need to be looking for? Well, I like to start thinking of, when I'm saying, well, what kind of trades do I want? I want to first ask the question, well, who's in charge? Who controls the market? And who controls the market is volume. Volume controls the market. Volume dictates price. So who dictates volume? Any guesses, everybody? Who dictates volume? Hedge funds, high-frequency traders, mutual funds, people, Bernanke. Well, Bernanke certainly is able to make volume increase to the sell direction usually. Large institutions, yeah. Basically, one of the things, I don't know if anyone's watched the 60 Minutes interview with the hedge funds of New York, but it's the smart money. They actually estimate, this is 3 years ago this figure was released, they estimate that 70 to 80% of the trades made every day are done by computers. Now, when I say computers, I don't mean me sitting behind my Interactive Brokers account. What I mean is actually algorithms that are programmed to buy and sell based on rule systems, based on being told that 10 is the price to buy at and 11 is the price to sell. They don't care at all about what the company does, who runs it, what the news is. To a certain extent, it's just simply looking at patterns. Now, people say to me, well, does that mean that high-frequency trading, Goldman Sachs, does that mean that they have 80% of the money? And great, Bill, I can see you asking the same question. No, it means 80% of the volume. Because let's say that there's 1,000 people in this room who all have $1, and everybody in this room goes out and buys a stock on Monday, the same stock, right? That means that everybody here on that day accounts for $1,000 worth of volume, okay? Now, let's say, however, I've just got $1. I come in with my $1, but I buy and sell the stock, that same stock you're in, 100,000 times, okay? So what that means is that I now account for 100,000 of the buying, but also 100,000 of the selling, because remember, I'm going both ways. So in fact, I'm actually, with my $1, accounting for $200,000 of volume, compared to 100 people in the room only accounting for 1,000. So I'm actually 200 times more powerful with a very small fraction of what the group represents. And this is what the smart money does. It's kind of like the, I wish I had a slide for this. It's kind of like a mouse, if you can imagine, a tiny mouse with the shadow of an elephant. That's kind of what it's all about. It's death by 1,000 cuts. Now, in order to be able to whip you like this, in order for the market to actually to be able to manipulate trades with this amount of volume, it needs to trade fast. So basically, these billions of dollars are made by these trading computers going in and out very, very quickly. Now, who remembers the flash crash, May 6, 2010? Right? This was one of the most beautiful moments for technical analysts. I remember a colleague of mine, Adam Mesh, he's a guy who's done, I met a couple of times, who does was on The Bachelor, he's a trader as well. I remember seeing him on TV talk about the flash crash and said, when that happened, it was one of the biggest gimmies of all 2010, because basically we got to see where the market was going to go for the next few weeks. So basically, for those of you who were not around then, the flash crash in May 2010 was where the market plunged 1,000 points and just in like minutes, and then hit some kind of magical floor and then went straight back up the opposite direction. Thanks, Alex. Yeah, we'll talk about that in a second. So the flash crash, if you think about the stock market, that's billions and billions of dollars that just went straight down, then hit a spot, turned right back the opposite direction as if nothing had happened. To turn the market with that much money going over and instantly turn it in the opposite direction, you need to have some power. Think about a Mack truck, a 100-ton Mack truck going down the highway at 150 kilometers an hour. To be able to stop that instantly, turn it back in the opposite direction, and have it continue going without changing speed at all. That would be some kind of feat. That's what happened on a gigantic scale on May 6. So where did they? What was the reason? Well, the financial system that's there to help you, right? That's there to educate you, said one of our traders slipped over and pushed the B button. Whoops! We sold billions of dollars worth of futures instead of millions. I don't believe that for 1 second. Just like I don't believe that this year the Nasdaq got shut down because someone tripped over an electrical cord. I mean, is this really what we're being fed? Yes, that is what we're being fed. We're going to come back to this because this is also where we can find opportunities. Because these forces that are controlling the market and pushing these billions of dollars around are making decisions using algorithms. And computers are not thinkers, right? They don't have arguments with their wives. They don't have arguments with their husbands. And hopefully there's a lot of female traders in the audience here today. There's there's none of that kind of that changing dynamic that the computers have. So because they're doing the same thing again and again and again, you can reverse engineer it. Now, I'll use an analogy. If you were to wake up in the morning and you found that all of the local shoe stores had been robbed, and you found that essentially everything missing from these stores was red Reebok shoes, what would you need to do to find where the next place would be that was going to be robbed? What would you look for? Anyone got any ideas? Blue Reeboks. Yeah. Well, red Reeboks, absolutely. So I realize the answer is obvious, but I mean the thing with trading is that that's exactly what we're looking for. We're looking for evidence of where the smart money is going to hit next. Okay, I don't care about like the retail traders. I don't care what people like me are going to buy tomorrow. I don't care about what everyone on Main Street's buying. It's interesting. I'd like to obviously follow public perception, but more because I want to do the exact opposite of what everybody else is doing. It's called the taxi cab index. I remember when I came back from Australia on January 9th, and I looked at, my cab driver was telling me how he's recommending I should load up on gold. January 10th, I hosted a trading room and told everybody in the audience that I was going to short the hell out of it. Because there's a few reasons. It was underneath its major resistance, the 161-day exponential moving average, and basically that people were suddenly all telling me it's time to buy. So I don't listen to people. I do the opposite of people. What I want to know is where the big money is going to get in or out, when the elephant is going to step into the bathtub, essentially. And Alex, another great point, the smart money, the big money is not always smart, but don't bet against it. Again, we'll come back to that a little bit later. But the first step to understanding how to trade with the smart money is to firstly understand the core components that move the market in the first place and how the smart money trades. So basically, in my opinion, a stock or index will generally only always change direction because it has hit one of a few things: a horizontal support resistance line, a trend line resistance, or moving averages. Okay, so one of these three things. In my mind, the market is not chaotic. It's actually moving with a high degree of control, but you just simply need to know where those points are where things could change. So when you're looking at the smart money, these massive forces that ultimately underpin the movement, algorithms don't see this. They don't look at candlestick charts. They're not looking at indicators. They're not looking at those things. Algorithms are essentially looking at these. Algorithms are simply looking at levels. And yes, Charles, pivot points absolutely would be another one, looking at open range trading, looking at pivot points, looking at, and I would call those horizontal support and resistance. Yeah, and yes, there is a method to the madness. Because when most people see the stock market and they hear, lunatics like me yabbering on about technicals, they think, wow, this seems really chaotic. This seems crazy. Well, let me use an analogy. Since I've been in North America now for the last 10 years, since I left my Australian home, and I started to analyze the voodoo lines, as TD puts it, absolutely. As you start to look at that, you say, wow, is this chaotic? But I'll liken it to watching my first American football game that I watched. When I first watched, I think the Raiders were playing, and I was watching the Raiders play against some other team I can't remember, and I remember watching these guys just running across the field. The whistle would blow, then all the players would run across the field at each other. Then one guy would run back, throw the ball while all these other guys ran up the side, and other guys. I looked at that and I thought, what the hell is going on? How can anyone understand this game? And I certainly couldn't. I probably still don't. I'm still trying to figure it out. But I'm sitting there looking at them going, okay, so what's really going on? And then I realized that even though looking at all these players running in different directions, what was actually happening is it was a very formulated play where the players knew exactly where to go, exactly how to move, when to turn and cut back. And I thought, wow, this is actually organized chaos. And what was beautiful about that was to actually see that not only was this one play, but there was actually probably about 50, 60, 70 different plays in that coach's playbook that played out. And all the players knew exactly what to go and do depending on what the play was. So when you start to look at the stock market, the reason I make this, draw this analogy or draw this comparison is because when you see the stock market, most people, most traders even, look at it like the first football game they've ever seen. And they try and trade all these different stocks, all these different strategies, without realizing it's really just a series of plays that have exact rules and ways to move. So that's basically what you're looking at. So when you look at the and thanks Swappin, excuse me, Charles. So when algorithms see these levels, you come back to the flash crash of 2010, you can see the stock at the S&P 500 had a pretty nasty correction here from 1140, 1160 even, down to just above 1040. And then, like the Mack truck, this massive amount of selling. This is a big series of 3 candlesticks down. Then hit this level at 1040 and went straight back up, all the way to 1220. Now that's a huge reversal. So that straight away tells me that the retail traders didn't do that. That was when the smart money got in. That's when the maybe I shouldn't say smart money. When the big money stepped in, was able to turn that Mack truck around. Now the flash crash happens. The fat finger or the B, whatever you call it, apparently causes the market now to drop, plummet. But where does it plummet to? Where does it stop? At exactly the same point that it turned around last time, and then goes straight back up the opposite direction, and goes and hits the 1180 resistance line, which is where it broke down from before. You can see these are the support and resistance. We now crash back down, come to the same area, bounce, break through, and so forth. If you want to look at if you want to go and look at stocks, for example, TD. TD is basically almost exactly the same. And if I can I'm just going to grab my pen here for a second. TD looks almost exactly the same. TD Bank basically looked almost exactly the same. Basically looks like this over the course of a 12-month period. That's what TD looked like, and it kept coming back to this same support line. My pen's a little bit laggy here, so not as nice as I'd like it to be. But I'd like to ask a question, though. This whole time that the market is oscillating, the whole time that, for example, TD was going back and forth 10, 20%, and coming back to the same price, the whole time that the market has been doing these huge moves up and down, who do you think's making money here? Because this is billions of dollars we're talking about. This is a lot of money being made, but not by the everyday person, by the professionals. And the fact is they're doing it right under everybody's noses in plain sight. I think the head guy, one of the head chief executives from, I think it was the NASDAQ, came on TV on the flash crash day. They said, how can you explain this? How did you react to it? And he had a really smug smile on his face. I remember watching it on TV. And he said, well, you've got to realize that we don't trade like you trade. And I knew right there what he was talking about is this. He's talking about the unwritten rules that are really actually not that difficult to see once you know what you're looking for. Okay, so I won't belabor the point. Let's move on to the next slide. So how do we find where the levels are? Where do we find that 1040 line that the market's going to reverse at versus, say, 1060, which would have been too soon? How do we know what to look for? Well, the first step is finding strong levels. So when we're looking for strong levels, there's a couple of questions we need to ask when we start looking at the chart. The first thing you want to do when you look at a chart is realize is to take the candlesticks off. You know, stop looking for the candlesticks first. What you want to look at is where the support and resistance lines are that dictate the movement. Think of it this way. If you had a children's coloring book, you know the ones where you can, where you give them to young kids and they get the crayons and they color in inside the lines, different colors inside the lines, and it makes a picture. Well, with stock trading, when you look at a chart, you're actually looking at that same coloring book but all the crayon drawn in without the lines. So when you look at a chart, you're looking at where all this color appears, and you've got to draw those lines on the outside of those colors to figure out what shape it makes. Okay? And that will then tell you what kind of pattern you're dealing with and things like that. Now, I'll come back to a couple of questions that I can see coming through the chat in a minute. But basically, when you start looking at the chart, the first thing you need to look for is horizontal and horizontal lines for support and resistance. Now, when you look at this chart, this is just obviously a hypothetical drawing I did last night. You can see that this stock has come down, bounced off this bottom support line, and it will then go up to hit the resistance, retrace, bounce, bounce, and come back down, and it ended up here. Now, if you were able to actually choose any of these levels to trade this stock next at, I'm just going to throw this out there to everybody. Let me ask you this question. If you were able to choose to do one of the following four things, which would it be? And this is a test for all you traders out there. Would you go long? Let's go from bottom to top. Number one, down the bottom. Would we go long at the bottom? Would we go long when it went to the second support line? Would we go short when it hit this resistance line? Or would we go short when it went to the top one? If you could choose which of these, would we go 1, 2, 3, or 4? From the bottom up, 1, 2, 3, or 4. You can see a lot of people saying long on the second support line. Some saying short at the third. I love that. And see, I think that the fact that we've got such a great diversity of answers in the room is exactly what makes trading so incredibly interesting, and why there's no one answer that works for everybody. But I think, yeah, long on one is exactly. Thanks for the bugger me moment. Peter, are you Australian as well? That's a bit of an inside joke if anyone knows that. Great Toyota car ad, if you ever want to search for that. It's called Toyota Bugger. Anyway, bit of humor there. So, okay, yes, the answer that I would certainly suggest is 1. Long at 1 or short at 4, in that order. The reason why is because when you're looking for the smart money, you're looking for when something really important happens, where, like when the market goes down 1,000 points and then changes direction so quickly with so much strength that it has to be the smart money. So when I look at resistance lines, these are the questions I want to ask. How quick did it go up? How fast and far had it dropped before when it turned around? When it went up from that level, how much volume came into it? And how aggressively, how quick did it turn and shoot up, and how far did it go up to? Finally, the last thing I'm going to ask the chart is how many times it's been hit. Just remember that most people, when they start trading, think that the more times a support line has been touched, so if something bounces off this level once, twice, possibly 3 times, that means it's strong. Well, it was strong, but every single time it hits that support line, it gets weaker and weaker and weaker. It's like chipping a little rock hammer against a glass window. The more times it hits it, the weaker it is, and the more likely it's going to smash the next time. So generally, I have a rule that I use, and I'd like you all to take this away from you, whether you've kind of looked at this before or not, but the rule of 3. As soon as a support or resistance line of any kind has been touched 3 times, I consider it useless. Okay, so look at you know, go away and look at all your popular trading patterns. You know, you look at wedges, usually break down after the 3rd. Ascending triangles usually break down after the 3rd touch or the 3rd drop. A lot of popular patterns, if you just go and have a look at a chart, you'll see stop working after 3. So what I want to look for is a fresh, strong level. So this was a fresh, strong level. It's only been touched once. When it hit that, it went up 1, 2, 3 levels. These levels have been touched several times and also weren't very strong or powerful. And the reason why this was my second choice was this is also still fresh, but it wasn't as strong as the first because it only dropped 1, 2 levels, whereas this went up 3. So this would have been my first choice, this would have been my second, and I would not even trade those 2, not in a million years. Because the reason why I wouldn't trade it is because I get the choice to trade only high probability trades, as do you. You're not being forced with a gun to your head to trade stocks. So here's a second question I ask. Once we've found the strong levels on the chart by looking at where these types of characteristics have happened recently and have been fresh, the next question we then want to say is, what kind of action do we want when the stock reversed? So again, I'll throw it out there. If you stored these 2 charts, A and B, and you're looking for a short, would you prefer to short here or would you prefer to short here? Out of those 2 different charts, if the charts appeared that way, which would you choose, A or B? Perfect, B. Absolutely. So B, the reason B is for 2 reasons. And if anyone can guess those reasons, just throw it up there. Looks like we've got a great group, a very educated group of people. So that's wonderful. Basically, so I wait for confirmation. Okay, I'm going to talk about that. So basically, the reason why B is for 2 reasons. One, it has a sharp reaction. This is called an Eve and Adam double top. This is an Adam and Adam double top. Okay, so if you actually look at the differences between these, Eve and Adam double tops are about, if you were to rank from 100 to 1, 1 being the best, 100 being the worst, an Eve and Adam double top ranks at about 50. It's a pretty middle of the road trading probability. I wouldn't even touch that. Why bother? I only want high probability trades. B are actually far more successful. And this is where we get these strong reversals. I'm just having a quick look at the clock to make sure I get through the rest of these slides. I could talk for hours about this stuff, as you could probably imagine. It's fascinating stuff. But this is where we want the high, powerful levels. The other thing as well, as you've actually identified, is you've got higher lows over here, indicating strength, equal lows over here. What would be even better is a lower low. So looking for the smart money, let's just do a quick checkpoint. Basically, in order for, once we locate these levels, now we need to locate the smart money. And we need to understand that in order for the market to move or change direction, the smart money has to agree. So you can go out and do all the research in the world you want, but unless the smart money agrees with you, you're wrong. Because if you found the diamond in the rough, and you found that that is the next best, next Microsoft, the next Apple, the next whatever, and you buy that stock, but the rest of the market doesn't agree with you yet, and you buy that stock at $5, yeah, it might be $50 in 10 years from now, but it might drop to $1 first before the smart money starts to get in. And if you're in at 5, that's a very painful loss to hold on to. So whatever the market does, you need the market to, whatever you do, the market has to agree. So despite underlying fundamentals, the timing has to be right also. So now to sort of figure all that out, we look for that fingerprint of the smart money. So let's do a smart money checklist. Basically, with smart money checklists, we want to firstly look for stocks that correlate with the sectors. Look for correlating trades with the market. Now, what I mean by this is if you actually get into a stock and you're seeing, if you're seeing that the actual healthcare is rallying hard this week, that doesn't mean go and look for healthcare stocks. It means go to your sector rotation model and anticipate what the next sector will be. What's the next sector that's strong, not what's strong right now. Because otherwise, if you react to what's performing now, you're behind the game. You're lagging. What we want to do is anticipate what's next, what's around the corner, and that's what smart money does. We want to be the trend setter, not the last one to the party. So looking for correlating trades the appropriate way. We then look for high probability zones, strong levels of buying, fresh levels, powerful levels. An example of this is CBOE. We've talked about in some of the previous presentations today, the Chicago Board Options Exchange. Well, here's the stock, CBOE, that represents that. And basically, this is a trade that I found in last year, actually, and with a perfect setup. You can see the stock had actually rallied up. This is the options exchange, remember, and then crashed, plummeted. Went back up, hit the same level with a lower high, crashed, plummeted. So I was waiting now with a predetermined alarm. I set this alarm up in Interactive Brokers in September 2011. And in September 2011, I said, next time it hits $33, which you can't see the price here, that's what the price was, 33 bucks, I want you to let me know, because that's a price where I'm pretty confident the smart money is going to pound the hell out of this thing. And yes, those are Bollinger Bands. Those are Bollinger Bands on the chart. And so that's exactly what happened. So it hit $30 and went straight down. And it went straight down to almost the exact same level it had before back here. So smart money, we had located that zone, and therefore weeks beforehand of it reaching this price, we were already prepared to actually get into that. So we go back to our checklist. These things had all matched up, and therefore the trade had met the first point. Next, we now confirm with indicators. So now we look for signs of oversold, overbought. So RSI, CCI, looking at things where oscillating is the underlying methodology behind the indicator. We look for the heavy levels of volume to occur at those levels. Again, we don't care really what people are doing. We want to know what the big money is doing. If big money doesn't support it, it doesn't matter, or it won't last very long anyway. And then we start to confirm using tools such as Bollinger Bands. So yes, these are Bollinger Bands. And who here uses Bollinger Bands already? Who have used Bollinger Bands in their strategy? Now there are so many ways, that Bruce C. Oh, hey Bruce, how you doing, mate? We've got a couple of our actual students in the room, it looks like. All right, so Bollinger Bands are great because what they do is they actually tell you where 94% of the stock's movement's going to be. 94% of the movement will be in these bands. And if it goes outside of it, it means it's likely to retrace back into the bands. All right? So if you look at here, every time it goes out, it comes back in. So Bollinger Bands, excellent way. So when we find a stock at a strong resistance point, we also want the Bollinger Band stock to be outside of it. Yeah, and we use Ichimoku too, absolutely. This now, because it's not about just one indicator, it's about how you use a multitude. Because each indicator is an ingredient that you use in a recipe. And depending on how you use it, it's going to depend on the strength. See, if I'm looking for a flag formation, then I'm looking for the stock to be going up outside of the Bollinger Band to go long on. If I'm looking for an extremes trade, I want the stock to be outside of the Bollinger Band to go short on. So indicators are not a magic money-making tool. They are simply an ingredient in your recipe that you decide how to use. Finally, once we've actually looked for the indicators to actually confirm, we then actually look for the charting pattern to confirm. So we talked about that a little bit. Make sure the charting pattern coincides with what we're looking for. And then finally, what we look for is accumulation and the smart money to be going in using money flow. And essentially what money flow does, the money flow indicators, chalk and money flow, is it actually shows you whether smart money is buying or selling. And here's a slide of that. This is the Chicago Board Options Exchange trade again. And you can see this is where we actually get a very good price and volume combination. Money flow indicator tells us, is price increasing, is volume increasing, and is the stock closing in the top half of the range? And in every single trade I do, I use this. Every single trade, it is vital. It predicted the crash in 2008. It predicted the crash in 2010 with the European Union crisis. It's a very effective system. And basically, if I see a stock that is at resistance above the Bollinger, and a number of other things I look for, but those are some of the key starting points, then I look for the money flow to be going down, and I want it to also be diverging. So you can see here that while we're at a higher price in the stock, we're actually creating lower highs on the money flow. Very effective system. This is, I know you probably heard earlier about divergence. This is a very powerful diverging indicator. And when you see that, when it's going down, diverging, very good system. See, versus a flag formation, different story. This is where you want the money flow to be going up. And when money flow breaks through zero, again, with the stock going above the Bollinger, this is where you get great longs. So again, you need to know how you're using the indicator to match up for your strategy. And that's what building the perfect storm is about. We want to know what all of the ingredients are, so that when they all line up, it makes the highest probability trade. Here's another analogy, guys. In poker, who plays poker here? Who's ever played a game of poker? We're all traders. I'm sure quite a lot of people have played poker. So with poker, can every hand win? Yes. Can every hand win? Yeah, you could win with an 8-3. Because you could get triple eights or 4 of a kind, no matter what the other guy's got. But just like in trading, any kind of pattern can work. You can make money with any kind of pattern or strategy. Doesn't mean it works. Doesn't mean you should play them. In trading, we want to be able to stick only to the high probability trades that give us the highest probability.
Illinois is down 7-0.
Let's have a quick look here. You see that, Andrew? Okay, so hopefully everyone can still see the slides there. So basically, with the ingredients that we're looking for, these are the 3 things that go into it. We're looking for triggers, conditions, and indicators. And every single thing of this is important. What are the conditions of the trade? What are the indicators to confirm? And what are the triggers that we're going to get into? So for trading the extremes trade, the trigger is we want the stock to be outside the Bollinger. The condition is that when it does that, it needs to be hitting a strong level of resistance. And it has to be a strong, powerful zone. Then it could be fundamentals. The indicators then confirm. I'll talk more about that if we get some time here at the end, but I'm just going to get towards the end of these slides. And I can take some questions. Basically, we've got constantly changing variables if you do not have a strategy and you're not able to replicate the consistency. If you know what your strategy is doing, you can actually program it. When you know what you're looking for, you can scan for it. You can find it in seconds. My business partner once said to me, John, if you ever do the same thing twice, you're wasting time because you can design a program to do it for you. Scans do that. So what are the next steps? I'll tied things up here for everybody. What are the next steps? Seek help in education. What we do, what we specialize in, is scanning. I don't want to trade everybody's strategy. I want to trade the ones that are highest probability where the smart money is located. And basically, in this market, going through September, December, it usually kind of dies off for Christmas, but then again from January through April, this is where I make all my money. Next year, I don't even intend to trade from June through August. It's just not worth it. For the time you put in, it's not that minimum effective dose I talked about earlier. Typically, this is where we make all of our money is in these times. I could talk for hours, as you could probably tell, and there's just not enough time to cover the amount of value in designing a specific scan to find only the high probability scans. Basically, for this reason, we're actually going to launch a 2-hour class here, which is actually on October 17th, which is also when the debt ceiling hits, so we're going to have some really interesting topics. Basically, what you'll learn is what the highest probability scans are. I'll be sharing with you the exact strategy that I use every single day. It's a long and a short. It's got 6 criteria in it to find with, mutually exclusive criteria. It's got several indicators we use for confirmation. I use it every single day. It allows me to minimize my time for 10 to 15 minutes a night. I'm usually done my scanning, picking trades for the next day within about 30 minutes, and I can go to sleep, set my stops, do whatever I want. We're going to be covering the high probability, low risk trades, entries, exits, risk rewards, and we're going to be giving you a checklist, a trading plan, and Excel documents to track everything. Basically, for registration, it's only 29 bucks. This is, as I said, our debut on Trading Pub. Morgan does a great job bringing everybody in and to access some of these great teachers and techniques. So we want to have you to have a really inexpensive way to kind of experience live what we do. This is actually a normally standalone course that we offer to people for $499. The 2-hour workshop actually went for 3.5 hours because we had so many questions. We ran one of these for the first time 2 weeks ago as a kind of a test to see what people's participation levels were. It was a blowout. It was absolutely incredible. You know, only 29 bucks. We're going to be doing it on October 17th at 4:30 p.m. Eastern. We'll also then be doing a repeat at 8 p.m. Eastern. So 2 times. I know that here it says 4:30, but we've actually already had the 4:30 is almost already sold out. So we have put a second time on at 8 p.m. Eastern. And we're going to be covering everything. I mean, it's an excellent way to get started. Yes, and it is cheap, TD, because we do want you to, we want to really kind of show off to you. We've had some incredible results this year. There's been, this market has been one of the greatest conditions that I've seen since 2000, well, I hate to say 2008, but 2008 was great for trading. We could be going into a very similar conditions. So you want to be armed, ready and dangerous. Will it be recorded? Yes. Everything we do is recorded. And in fact, if you miss the live session for some reason, we actually allow you to sit in on another live session with another group. So we want you to get full value out of this. And what I want to do for everybody in the session is to allow you, by the end of that workshop, I'll try as hard as I can to stick to 2 hours, is to give you a full foundation and platform to go away and trade with. We'll also be giving you charting tools included in this for you to actually run the scans with. Once you finish the workshop, you get to keep the charting program and you get to keep the scans. You don't have to pay any monthly fee or anything. We are, as I heard in an earlier session, we're teaching you to fish. So by the end of this workshop, you want to walk away and never talk to us again. You will walk away a far better trader, or a far more resourceful trader is maybe a better way. Because I know there's some excellent traders in this room. I work with guys who deal with big accounts, hedge funds that I've worked with, and no matter how well you trade, it's always about having efficiency. So if you're making 100% a year right now, but you're spending 3 hours a day finding your positions, let me help you turn that into an hour or less. So we'll give you all of that in that session. One special thing before we start tying it up is for the first 10 people that actually call in or sign up through the website, we will actually be giving away a one-on-one strategy session with myself to actually help you develop your own custom scan. So if you like trading a specific type of stock, maybe you like fundamentals and you want to combine them with your technicals, maybe there's scans that you've never really known how to do, but you know what you are looking for, but don't know how to do it, or maybe you don't know how to backtest your scans to see if they work that well as you think. If you're actually one of those first 10 people to get involved, we will actually be giving you a free one-on-one session, which is very valuable with myself, and we'll sit down and actually help you custom design that using your own program or using the program we give you. I've used every charting program there is out there, almost, I think. So we'll help you design the scan for you. Because again, maybe your strategy is great and you don't know how to automate it. We'll help you do that too. Does the scan and charting tools work on Thinkorswim? Absolutely. I've designed the scans I use in Thinkorswim, TC2000, Metastock, Incredible Charts, TradeStation. I've used it on everything because I just work with so many people with different programs that we want to make sure it's versatile. This is actually by the way, yes, there is a 100-person limit to the actual workshop. So a limit of 10 people to the one-on-ones to dial in. Also, if you want to dial in and ask any questions, we will be here for the next 3-4 hours. I've actually got a workshop here. I'm teaching a group of students from Vancouver in about 4 hours. So we'll be here to take your questions and chat to you if you'd like to shoot the proverbial, so to speak. That's our phone number. And actually, this is actually, I see Bruce, you're actually in the session today. So welcome back. These are actually two of the emails we got this week from people that have been working with our strategy. Deborah was from actually the last 2-hour workshop we did. This is what she had actually emailed in. And Bruce, who I can see is in the audience, one of our students who's actually going through the full course with us right now. So, you know, I can promise you'll get excellent value out of this. A good bottle of wine costs more than $29. So hopefully this will be something you can really take away from and apply to your trading immediately after leaving the workshop. Do we have a trading room? Absolutely. That's probably the best part of my job. I love the trading room. All of the students, both past and present, all actually come and join us on Tuesday and Thursday afternoons. We analyze the market live, and then what I actually do is I then announce, as do the other coaches in the room, what we're going to buy with our own money the next day. So we'll say, okay, we'll do the scan, talk about what stocks we're buying. We'll say, okay, this is the stock that we're going to buy, the reasons why. This is the indicator readings. So yeah, we do a trading room. That is the funnest part of everything that we do is putting things into practice. Walking down the street in Vancouver costs more than that. It sure does. I think my coffee and bagel this morning cost me about $12.50. But I guess that's what you pay for a JJ Beans quality coffee. Is the scanner extra? No. I will be teaching you using a tool that is free, the best price. And so that'll allow you to actually to build those in. And any custom scans, I saw a question I missed earlier about FinViz. FinViz is one of the tools I also use when I want to combine fundamentals with my technicals. In fact, and this is worth mentioning. Guys, we're coming up to earnings announcement, earnings season. I have an amazing scan that only works 12 days of the year. And it's the 3 days leading up to option expiration Friday in a month of earnings. This is a really cool scan. I do it in FinViz. And no, the scanner isn't extra. Everything we do, everything in that session is all included in that $29 price, including the scanner, including the scans, and including the 2-3 hour workshop. And including access to it if you want to attend it again in the future. We do record the webinar. It is sent out immediately after. But yeah, this option scan is very powerful. We basically have a combination, a hybrid of fundamentals and technicals in one that searches for stocks that and it works extremely well, finding stocks that are set to plummet or rally on a big surprise announcement, going into expiration on the Friday, where you can get like very, very cheap contracts. So what we're basically looking for is we're looking for puts or calls where we can buy for, say, 5 cents, 10 cents, where if the stock does the big surprise we're expecting, we're going to be able to sell it maybe for $1 or $1.20, like which some of the ones we picked out this year was Microsoft, where I think there was about a 1,200% change overnight in the option price going into their announcement. And the technicals and fundamentals were perfect.
All right, great. Thank you, John. Again, excellent job today. We appreciate you being here. Your first time at the Trading Pub. We'll definitely have you back very soon. Again, always love to have new people on here that do a great job of educating. So again, a quick recap, the special 2-hour workshop, I'll post the link for you one more time. It's https://www.acornwealthcorp.com/yes. So again, it's $29, and you guys can take that. I believe he said he is recording the class. They're limited to 100, so if one fills up, I think they were close to filling one, and they opened another one for that night, but they will record. So thanks again, John. We appreciate you. And what I'm going to do now, I know we've probably got a good bit with this many people in the room based on some of the comments in the chat. We've probably got a good bit of people signing up for that. So while my good friend Dave Osman is getting his screen sharing going, I'm going to put a timer up here for 2 minutes so you guys can continue to sign up for that, and then we'll transition to the next speaker. Sophie, yes, shoot me an email real quick, and I can get it to you. All right, well, good deal. Well, we're just now at the time to turn things over to our next